The news is all about interest rates. We had Janet Yellen and the Federal Reserve met on March 18th and talked about their Fed policy. They read their statement, and the one word that they removed was patient. What does that mean? It means that the Fed has been massaging interest rates for quite some time. We know that interest rates are near zero. For savers, they're earning hardly any money at all in their savings account or bonds. For people borrowing money, whether it be for a home or businesses, they're getting very low interest rates. Mortgage rates are at historic lows. And it's time for interest rates to start creeping up. That's because the economy is growing. So when interest rates go up, when the Federal Reserve raises interest rates, that means that they feel the economy is growing and they want to control how fast the economy grows. Because when the economy grows too fast, consumers will spend too much on goods and services, which is in what we refer to as inflation. When inflation rears its ugly head, if it's not controlled, it could create damage in the economy. That's the Fed's number one job right now. So after 7-8 years of having interest rates be near zero, the Fed this week said that they will be willing to raise interest rates as soon as they feel it's prudent. They have been waiting for unemployment to come down to between 5.2 and 5.5%. Last month's unemployment number was 5.5%, which is on the high end of their target. And with the economy growing, more people going back to work, you may see the Fed raise interest rates. Could be June, September, or early next year. Nobody knows, but we do know interest rates will go up. Now that we know interest rates will be going up sooner than later, what should investors do when investing in their fixed income securities, whether it be CDs, bonds, treasury, or corporate? Doesn't matter. Usually when consumers buy bonds or CDs, they can lock into a maturity. Short-term CD, long-term CD, the same with bonds. Do you buy a 1-year, 5-year, 10-year, or 30-year bond? Knowing that interest rates will go up, patience will pay off for different reasons than what Janet Yellen and the Federal Reserve Open Market Committee used the word patient for. Patience will pay off because the longer a consumer waits to buy that bond, the more interest they will receive. Plus, we're coming off a 30-year rally, basically a bull market for bonds. If you go back to the early 80s, and you can see from the chart that you're looking at, interest rates were in the high teens. They've come all the way down to near zero. Interest rates will start to creep up. And because bonds have an inverse relationship between interest rates and the price of the bonds, if you were invested in those bonds with interest rates coming down, the value of those bonds, the price has gained appreciation, you've made some decent money in the fixed income arena. As you can see from the chart, it's been a great 30-year ride for bond investors, anybody invested in fixed income instruments. Well, now that's over. And knowing that there's an inverse relationship, that means that when interest rates go up, the value of the bonds will go down. So, looking ahead, a lot of investors, if they're invested too heavily in bonds, they could see negative returns on their investments, because when interest rates go up, the value of the bonds go down. And this is where patience will pay off for consumers buying bonds. Let's just use the 10-year U.S. Treasury note as an example. You can buy a 10-year Treasury note today yielding 2%, knowing that for the next 10 years you'll receive 2% year in, year out. But what happens a year from now if the 10-year Treasury notes yielding 3 or 4%. You're stuck with that 2% Treasury note. That's because the only way you can get out of it is to sell it at a loss. New investors looking to invest money in a 10-year Treasury note will buy a new bond yielding 3 or 4%, whatever that higher interest rate is. So the bond you have, now you're stuck with it for the next 9 years yielding 2%. If you're buying bonds, you need to be careful. You don't want to get greedy. You want to be prudent. You may want to ladder maturities, because interest rates, as they rise, you will want to lock in getting a higher rate. And it may take a few years for you to do that. So don't rush out and buy a long-term bond just because interest rates went up a little. Over the next couple years, interest rates may go up a lot more. So you'll want to be patient and buy those bonds in the right manner. Hopefully today's segment will give you a better understanding of why there's so much talk about interest rates, why Wall Street focuses on the Federal Reserve meetings, and which direction will interest rates go. But long term, remember, if interest rates go up, if you're a stock investor, that's good news. The economy's growing. Corporate America should earn more money because they're selling more goods and services. When interest rates go up for savers, they'll earn more money. That's good also. Consumers borrowing money or businesses looking to reinvest back in their businesses by borrowing money, they will suffer. And then there will be a whole new cycle. Thank you for taking time out to listen to this segment. We will have more segments soon.